Hello everyone, this is Kevin Zhao, your finance professor at MTSU. In the previous chapter, we discussed some of the basic concepts of financial statements and cash flow. And in this chapter, our goal is to expand our understanding of the uses of financial statement information. By completing this chapter, you should be able to know, first, how to standardize financial statements for comparison purposes. Second, how to compute and interpret important financial ratios. And the third one is to determine the determinants of firm's profitability and its growth. At the end, you should understand some problems and pitfalls of financial statement analysis. And here's the outline of the chapter. We have 5 different topics to discuss: standardized financial statements, financial ratio analysis, the DuPont identity, internal and sustainable growth, and how to use financial statement information. Now, let's start with standardized financial statements. One obvious thing that we want to do with a company financial statements is to compare them to those of others, similar companies, and we should immediately have a problem because it's almost impossible to directly compare the financial statements for 2 different companies because of differences in size. To start making comparisons, one thing that we can do is to somehow standardize the financial statements. And one very common and useful way of doing this is to work with percentages instead of total dollars. And the resulting financial statements are called common size financial statements. In the common size balance sheet, present all items in percentage of total assets. In the common size income statements, present all items in percentage of sales. And the standardized statements are very useful for us to compare financial information year to year, and also can facilitate comparison between companies with different sizes, particularly within the same industry. Now let's take a look at one example of common size financial statement, and this is a balance sheet for a company called Prufrock Corporation. And as you see, there are 2 columns, one for year 2013 and one for year 2014. And this is the balance sheet published by company at the end of year 2014. And here you see total assets is a little over $3 billion, and total liabilities and owner's equity is the same number. Here you see, okay, there are a lot of numbers, but when you compare those 2 columns, what can you say? Well, you can say, hey, comparing year 2013-14, cash increased a little bit, account receivable increased a little bit. I mean, it looks like everything increased a little bit, but by how much? By how much? And here, let's take a look at a common size balance sheet for this company. And here we express all items in percentages of total assets. For example, cash in year 2013 accounted for 2.5% of its total assets. Right? And here you see the distribution of different type of assets within this company. And for year 2013, a little over 19% of assets are current assets, and a little over 80% of assets are fixed assets. And for liabilities owner's equity, you see that in year 2013, total current liability accounted for 16% of total assets, while the long-term debt accounted for nearly 16% of total assets. And owner's equity accounted for 68% of total assets in this company. So essentially speaking, $1 out of $3 in terms of total assets are financed by debt. Right? And in year 2014, those percentages have been changed. For example, the percentage of cash increased from 2.5% to 2.7%, and here you see the difference is 0.2%. So cash flow increased a little bit by how much? 0.2% of total assets. And while total current assets are increasing by 0.7%, but total fixed assets decline by 0.7%. In terms of liabilities and owner's equity, you see that total percentage of current liability declined to 15%, and total long-term debt declined from 15.7% to 12.7%. So here you see a significant decline in long-term debt, which means company used a lot of cash last year, paid off those debt. And owner's equity has increased from 68% to a little over 72%. So here's another significant increase in owner's equity. So from here you see that common size financial statement can help us to do historical comparison, so we can compare the percentage of each every accounting items year by year. Now let's take a look at income statement, and here is the income statement for Profrock Company in year 2014. Once again, start with sales, then we subtract the cost of goods sold, depreciation, interest paid, taxes to come up with number for net income. Well, common size income statement express all items in the income statement in terms of percentage of sales. And here you see, okay, sales, of course, by definition is 100% of sales. And cost of goods account for 58.2% of total sales. Depreciation about 12%. So earnings before interest and taxes here is equal to nearly 30% of total sales. That means EBIT margin, earnings before interest and tax margin is about 30%. Then we consider interests and taxes, and the net income is about 15.7% of total sales. That means the profit margin for this company is 15.7%. So the common size income statement gives us a very clear picture on the cost structure of the company. Of course, you can use those ratios to do historical comparison and peer comparison. What is historical comparison? Well, we compare this year's company operation results with results in the previous years to see if there any improvement. And also we can compare this company's ratio with other companies to see what are major differences among competitors. Now, let's go a little bit further to introduce what's called financial ratio analysis. Financial ratio analysis is a great tool for us to facilitate comparison through time and between companies. And the financial ratios are used both internally and externally. Internally, sales manager, inventory manager, financial manager, CEOs are examining those financial ratios very carefully, trying to capture the weakness and strengths of their company so they can improve upon of that. And externally, investors and other competitors are looking at one company's ratio very, very, very carefully to see what's the difference between those competitors, and it's a very useful tool for both internal and external stakeholders to examine the situation in the company. So for each every financial ratio, you need to ask yourself what the ratio is trying to measure and what the information is important. And throughout this chapter, you will see a lot of formulas, maybe more than a dozen formulas that you need to work with, and you will go through a lot of calculations based on those financial ratios. But the first thing that I want you to know before you do any financial ratio calculation is that financial calculation itself is useless, right? And the useful thing about the ratio is, first of all, to interpret. What does it mean for a specific ratio, right? And how to use those financial ratios. And essentially speaking, we use the financial ratios to facilitate comparison to assist our managerial decision within a company, right? And you need to remind yourself the practical aspect of financial ratio analysis. Calculation is the least important ones, although you need to go through a lot calculations in this chapter. But the most important thing here is, first, interpret what does it mean, right? And the second, what's those ratio? How to facilitate comparisons by using financial ratios. Now let's take a look at 5 different categories of financial ratio. As I said, there are more than a dozen financial ratios that you need to deal with in this class, but we can put those ratios into 5 different categories. Right? The first category is the liquidity ratio, and we call the ratio as short-term solvency ratio, and those ratios are a very important ratio for bankers who lend money to the company and to debt holders of the company. And essentially speaking, liquidity ratio actually measures how sufficient the company is backed up for its short-term liability. Right? Short-term liability is the money that the company needs to pay back within the next 12 months. Right? If company cannot deal with upcoming debt requirement, then technically speaking, company is in a shape of bankruptcy. So company needs to have liquid assets, right, which can be transformed into cash within next 12 months. So that actually is a strong backup for short-term liabilities, and liquidity measures how sufficient that short-term liabilities are backed up by different types of current assets or short-term assets. And the financial leverage ratio measures the long-term solvency ratio of the company. And by saying long-term solvency, we look at the capital structure of the company to see how company is leveraging its operation by introducing long-term debt. And asset management ratio are typically turnover ratios, and those ratios can help us to examine how efficient the company is running its business in many different areas. For example, we'll see how efficient company is managing its account receivables, inventories, total current assets, and the total fixed assets, so on and so forth. And the fourth category of profitability ratio, and here we use several different ratios to measure how profitable the business is for a typical company. And the last one is market value ratio, and here we look at the stock price to see how the market is evaluating the company, and there are several ratios that we can utilize to see how market is evaluating a company. Now, Let's take a look at this big table, right? And as I said, there are more than a dozen ratios, financial ratios that you need to take care of, and those are formulas for let's see, about 20 ratios in those 5 categories, right? Short-term solvency ratio, financial leverage ratios, assets management ratios, profitability ratios, market valuation ratios. Actually, there's more than 20 of those. Right? And I want you to use this table. Right? And ideally, I want you to print out the hard copy of just this slide. Right? Make it handy so you can get access to each every financial ratio very conveniently when you need to deal with homework questions. And you don't need to remember all the ratios. You don't need it to. But for exam purposes, I suggest you to focus on actually 4 ratios. You need to remember 4 ratios, right? 4 ratios for your future exams. And those ratios are ratio in so-called DuPont identity, or DuPont formula, or DuPont equation. Right? Here you see that DuPont equation in within the profitability ratios. ROE equals profit margin times total asset turnover and times equity multiplier. So if you need to remember any ratios or formulas, and I would say here is the one. Here is the one. Now let's go through first category of financial ratios, and those are liquidity ratios. And as I said, liquidity ratios actually measures how liquid that company assets are in order to deal with the short-term liabilities. I mean, short-term liabilities are something that a company have to deal with within the next 12 months. And for this company, as you see, current liability equals 540. That means company need to pay back 540 million US dollars. That's a lot of money, right? Within 12 months, within next 12 months. So the question is, where did the money come from? Well, here, I mean, company can use cash, but here the company doesn't have 540 million US dollar cash. It only has 98 million US dollar cash. Right? Don't worry too much because in the next 12 months, account receivables and inventories along with other current assets can be converted back into cash. And those current assets are strong backup for current liabilities. So for a healthy company, you would expect that total current assets is greater than total current. Is greater than total current liabilities, so that liabilities are 100% covered. And from this company, you see that is the case. Current ratio equals current assets divided by current liability, and the number is 1.31. What does that mean? 1.31. That means for each dollar of short-term liability that the company needs to pay back within the next 12 months, there are $1.31 of current assets available as backup. So in this case, it's pretty sufficient. And the second ratio is quick ratio. Quick ratio actually exclude inventories from current assets in calculating the liquidity ratio. The reason why we exclude inventory is because we believe that inventory is not a good backup for short-term liabilities. Right? And when a company is in trouble, if they need to sell all the inventory in a short time period, well, they have to take steep price cut on the inventory. So inventory is not that liquid. It's not as liquid as cash or account receivable. Therefore, we exclude this item from our calculation to get another ratio called a quick ratio or asset ratio. And here asset ratio is 0.53, which means company may not have sufficient backup for its current liability if we exclude inventory from our consideration. And the last item is the cash ratio. You just look at how much cash is available at this time in order to deal with future current liability payment. And here we see that number is 0.18. That means for $1 of current liability that we need to deal with, there's only 18 cents of cash available at this moment. So all three ratios can help us to understand how liquid company assets are, and so we know how sufficient those current liabilities are backed up by different types of current assets. Once again, when you get those numbers, you see 0.53 for quick ratio, 0.18 for cash ratio, and 1.3 for current ratio. Are those ratios good or not? You would say maybe yes, maybe no, but I would say you don't know yet, right? Unless you do comparison. I mean, when you say better or worse, you are doing comparison. Better or worse than what? Right? Better or worse than last year, or better or worse than its competitor. So comparison is the key. Once you get a ratio, those ratio probably won't tell you a lot of information on how good company operation is. You have to do the comparison by using those ratios. Now let's take a look at a financial leverage ratio, and a financial leverage ratio to see how company's operations are leveraged by borrowing money from long-term debt and current liabilities. And here we have three major ratios to look at. First one is total debt ratio, that equals total debt divided by total assets. And here the number is 0.28, which means for each dollar of total assets, for each dollar asset operated in this company, about 28 cents of that $1 is financed by debt. Right? And debt to equity ratio is equal to total debt divided by total equity. And here the number is 0.38. 0.38. Right? So here you see, okay, for each dollar of equity that a shareholder has in this company, there's 30 cents of debt come along with it. An equity multiplier is the one that you have to remember, right? Because that is the ratio that you see in the DuPont equation, and is equal to total assets divided by total equity, and also equivalent to 1 plus total debt divided by total equity. Right. So previously we calculate debt to equity, that's 0.38. So equity multiplier should equal to $1 or 1.38. Or you can use total assets divided by total equity, and you will get exact same answer. So equity multiplier 1.38 means for each dollar of equity the company has, the total assets is 1.38. Total assets 1.38, which means the operation and the size of the company has been leveraged up by 38% based on debt financing. And here's more ratios associated with financial leverage. I mean, bankers or debt holders who lend money to the company are very interested in how company can pay back. I mean, not only principal but also interest on a periodical basis. And here we see time interest earned and a cash coverage, and both ratios are used to measure how sufficient that interest payment is backed up by company's operation. And the time interest earned equals EBIT, as we know, that is earnings before interest and taxes, right? That is the money that a company made for all stakeholders, right? For government, for debt holders, and for shareholders. And we use that number divided by interest, and here you see 4.9 times, which means for each dollar of interest the company needs to pay back for next time period, there are $4.90 of operating income available. And in this case, you would say, hey, interest payment is pretty secure because company is generating sufficient amount of operating profit as the backup. And the cash coverage actually adding to the non-cash charge of depreciation. And here we get EBIT plus depreciation divided by interest, because depreciation is something that we excluded from calculation of EBIT, but depreciation is a non-cash charge. So when you add that back, you get a better picture of how much cash flow is available for company to deal with the future interest payment. And here the number is 6.9 times, which means operating cash flow is 6.9 times of interest payment, right? So from lender's perspective, you would say, hey, I don't need to worry about interest payment at this moment, because those payments are well backed up by operating profit and operating cash flows of a company. Now let's examine a little bit on the third category of financial ratios, that is financial management ratios. Right? So For financial management ratio, you see all kinds of turnover ratios, right? And those turnover ratios can help us to examine how well the company manages its own assets in different areas, right? And from the balance sheet, you see, okay, a typical company will have several different types of assets. For example, cash, account receivable, inventory. Those are short-term assets, and also the company has long-term assets. And here, we should look at how efficient the company is utilizing those assets in generating sales. Inventory turnover equals cost of goods sold divided by inventory. And in other textbook, you might see it's equal to sales divided by inventory. It's similar to each other, but the point here is if cost of goods sold is considered, then it's production-focused method. But if sales is used in the equation, it's marketing-oriented method. But here, in this textbook, I want you to use cost of goods sold in calculating inventory turnover. So cost of goods sold in this case is 1344, and inventory is for 422. So inventory turnover is 3.2 times. What does that number mean? 3.2 times. That means the inventory investment the company made in year 2014, which is $422 million, has been rotated for a little over 3 times within the corporation in generating new sales, right? And now let's take a look at second ratio, days sales in inventory. That's equal to 365 days in a year divided by inventory turnover. That is 114 days. So essentially tell you this 114 days essentially tell you that, okay, inventory, it takes 114 days for all inventory to be rotated within this company. Of course, shorter the number, the better the management of its inventory in a company. Receivable turnover equals total sales divided by account receivable. AR here means account receivable, right? And it measures how efficient company manages account receivable. And account receivable is the asset of the company, but that asset is used to lend money to customers so that sales can be increased. So the purpose of making investment in accounting receivable is to generate more sales. So here, higher the number means better the management of account receivables. 12.3 times, is that good or bad? Well, you cannot say unless you do comparison compared to last year's number and numbers for other competitors. Days sales in receivable equals 365 days divided by receivable turnover. And in this case, receivable is rotated within the current firm on 30 days basis. Payable turnover measures how efficient companies utilizing account payables, and is equal to cost of goods sold divided by account payables. Days costing payable equals 365 days divided by payable turnovers. And both items are used to measure how efficient companies managing its account payables. And the fourth ratio is total assets turnover for asset management, and it measures the overall efficiency of asset management. That equals total sales divided by total assets. Total sales divided by total assets. And here the number is 0.64 times, which means all assets within this company is rotated for less than 1 times a year. And the capital intensity ratio equals 1 over TAT. What is TAT? TAT is total assets turnover. And the number is 1.56. Higher the number means higher capital intensity. So in this company is a very typical company that has high capital intensity, which means company's operation is mostly based on fixed assets, investment on long-term investments. And higher the intensity the more fixed asset the company is using for generating future sales, and more long-term assets exist in the company, and the lower the asset turnover you will see. Okay, before we go through profitability ratios, let's take a short break.